Welcome to Love You Say Market. Today, we will learn everything about the US stock market, starting from the very basics to advanced concepts explained simply so anyone can understand. This video will cover every important detail you need to know to become confident in investing in the US stock market. Make sure to watch until the end and don't forget to subscribe or follow for more updates. The stock market is a place where people buy and sell shares of companies. Shares represent ownership in a company. When you own shares, you own a small part of that company. The main stock markets in the United States are the New York Stock Exchange, known as NYSE, and NASDAQ. These are large marketplaces where stocks are traded. NYSE mainly has big established companies, while NASDAQ is famous for technology and growth companies. Stock prices change every second based on how many people want to buy or sell. This is called supply and demand. When many people want to buy a stock, its price goes up. When many want to sell, its price goes down. These price changes happen because investors have different opinions about how well the company will do in the future. To buy and sell stocks, you need a brokerage account. This is an account you open with a broker, a company that allows you to trade stocks. Some popular brokers in the US are Robinhood, Fidelity, Charles Schwab, and E*TRADE. You deposit money into your brokerage account and use it to buy shares of companies. Most brokers now offer zero commission trades, so you don't have to pay a fee to buy or sell stocks. Once you buy stocks, you become a shareholder. Shareholders have rights like voting on company decisions during annual meetings and receiving dividends. Dividends are payments made by companies to shareholders from their profits. Not all companies pay dividends. Some reinvest profits back into the business for growth. There are two main styles of investing in stocks. The first is long-term investing, where you buy stocks and hold them for many years, hoping their value will increase. This is safer and helps you grow wealth gradually. The second is trading, where people buy and sell stocks quickly to make profits from short-term price movements. Trading is riskier and requires more knowledge and time. An important concept in investing is diversification. Diversification means spreading your money across many different stocks or other investments to reduce risk. This way, if one stock loses value, others might gain or stay stable, balancing your overall portfolio. One easy way to diversify is by investing in exchange-traded funds, or ETFs. ETFs are baskets of many stocks that trade on stock exchanges, allowing you to own a wide variety of companies with one purchase. Market indexes are like barometers for the stock market. They show how a group of stocks is performing overall. The three main US market indexes are the S&P 500 Dow Jones Industrial Average and NASDAQ Composite. The S&P 500 tracks 500 of the largest companies in the US, giving a good picture of the whole market. The Dow Jones tracks 30 large, well-known companies, and NASDAQ focuses more on technology stocks. Understanding stock quotes is essential. When you look up a stock, you will see its current price, the volume of shares traded, and how much the price has changed during the day, either as a dollar amount or a percentage. For example, if a stock price moves from $100 to $105, it has increased by $5 or 5%. The volume tells you how many shares were bought and sold. High volume means many people are trading that stock, which often means it is popular or important news came out. Market capitalization, or market cap, is the total value of a company's shares. It is calculated by multiplying the current stock price by the total number of outstanding shares. Companies are classified as large cap, mid cap, or small cap based on their market cap. Large cap companies like Apple or Microsoft are usually stable and pay dividends. Small cap companies are smaller and may grow faster, but are risk. The stock market goes through cycles of bull and bear markets. A bull market is when stock prices rise over a long period and investors are optimistic. A bear market is when prices fall and investors are worried. Knowing these cycles helps investors decide when to buy or sell. Sometimes companies do stock splits. A stock split means dividing existing shares into more shares to lower the price per share and make it more affordable for investors. For example, a 2-for-1 split doubles the number of shares you own but halves the price of each share. Your total investment value stays the same. Taxes on stock investments depend on how long you hold your shares. If you sell within 1 year of buying, your profit is taxed as short-term capital gains, which can be at a higher tax rate. If you hold for more than 1 year, your gains are taxed at a lower long-term capital gains rate. Dividends are also taxable, but qualified dividends have a lower tax rate. Understanding taxes helps you keep more of your earnings. Bonds are another type of investment that loan money to companies or the government. They pay interest regularly and return your initial money after a fixed period. Bonds are safer than stocks but offer lower returns. Many investors balance stocks and bonds in their portfolio to reduce risk. Your portfolio is the collection of all your investments. Managing a portfolio means balancing different types of investments according to your goals, age and risk tolerance. Dividends are important for many investors. They come from company profits and can be paid quarterly or yearly. Reinvesting dividends by buying more shares can grow your investment faster through compounding, which means earning returns on previous returns. Dollar cost averaging is a strategy where you invest a fixed amount of money regularly, like monthly, regardless of the stock price. This helps you buy more shares when prices are low and fewer shares when prices are high, reducing the risk of buying at a bad time. Blue chip stocks are shares of large, stable companies with a long history of good performance and regular dividends, such as Coca-Cola and Johnson & Johnson. Growth stocks belong to companies expected to grow faster than the market average, often in technology. They may not pay dividends because they reinvest earnings. Value stocks are those that appear cheap compared to their earnings and may pay dividends. Avoiding stock market scams is crucial. Always use trusted brokers and never trust promises of guaranteed profits. Do your own research before investing. Use stock market apps to track prices, read news and trade stocks. Apps like Robinhood Fidelity and Yahoo Finance provide useful tools for beginners. Investing wisely can lead to financial freedom and security for the future. Many investors find that developing a strategy based on their personal financial goals is key. As markets fluctuate, maintaining a level head and sticking to that strategy is essential. Building a diverse portfolio by including various asset types helps mitigate risk. Remember, patience is a virtue in investing. Long-term growth often outweighs the temptation to chase quick gains. As the sun rises over the calm lake, it reflects the hope and promise that comes with patience in investing. Dedication to learning and understanding the stock market can lead to new opportunities and fruitful returns. Patience is key in investing. The market will have ups and downs, but over the long term, it tends to grow. Staying invested and not panicking during market drops helps you build wealth. Stay updated by following reliable financial news sources like CNBC, Bloomberg, and the Wall Street Journal. Finally, investing in the stock market requires learning discipline and patience. Start small, diversify your investments, keep learning, and don't let emotions drive your decisions. Thank you for watching Love You Say Market. Subscribe or follow for more simple and clear stock market guides. Remember, start small, stay smart, and grow strong.